Hi, folks. Adam Taggart here. I co-founded Peak Prosperity along with my business partner, Chris Martinson. While Chris is busy filming the next coronavirus video that we'll be releasing later today, I wanted to talk to you briefly about today's market meltdown. Today is March 9th, 2020, and at the time of this recording, the S&P is down over 7%, the Russell is down over 10%, oil was down over 30% when the market opened today, and bond yields are cratering. So we are seeing another market meltdown, and we've seen several over the past 2 weeks. It's a very scary time for most investors, so we wanted to check in with Peak Prosperity's endorsed financial advisors, the folks over at New Harbor Financial. We've long worked with them to warn folks just like you about the risk of a market break like we're seeing right now in the markets. Valuations have gotten way ahead of fundamentals for many, many reasons over the past many years. We've been ringing a loud warning bell that the risk of a market breakage has been increasing, and we're beginning to see that happen in real time right now. So the folks from New Harbor, as I mentioned, we've worked for them for years to warn people about this, but also to help them position against this risk, helping folks use risk mitigation and defensive positioning to get their portfolios to a place where if the markets do correct like the way they're doing right now, they'll fare much better than the average person who's just fully long the markets. So with that being said, let's check in with the lead partners from New Harbor Financial, Mike Preston and John Lodra. Guys, thanks so much for taking the time to join me today. I know it's a very busy day for you.
Thanks, Adam.
Well, we just did one of these, about not even 2 weeks back, guys, when the market had fallen something like 12%. Today, the market is down more like 19%. And I want to pick up right where we left off. But before we do, I just want to ask you guys, how has your portfolio fared over that time? So from the mid-February highs, I think the market is down, as we're talking, about 19%. What's the New Harbor general portfolio doing?
Hi, Adam. This is Mike Preston. Just want to introduce ourselves. This is my partner, John Lodra, just so that you viewers know who's who. Yeah, it seems like, was it just about 8 or 10 days ago we were on last time. The markets are moving fast. Things are changing quickly. Very fast-paced, very dangerous market that we're in right now. Like you said, from high to low so far, the S&P is down a little over 19%. Our general portfolio, our core portfolio, is up about 1%.
Wow.
That's for our core portfolio in which we're able to use our full tools like hedging and options. There are some small group of accounts that don't use those hedging tools, but we're up about 1% overall and still very, very conservative in this market.
Great. Guys, that's great to hear. It's a huge relief for us because we have put forth you guys as a financial advisor who really is an expert on risk mitigation to our audience. That's a huge reason why we endorse you. And it's just wonderful to see that you guys deliver the value proposition that you have for years been telling our subscribers and our folks that we've sent over to you that you will. In other words, using hedging, putting defensive measures in place so that, yes, you're trying to get some prudent growth in the tough markets that we've had, but first and foremost, you're prioritizing not losing capital. Right, we're big fans, especially in the overvalued markets that we have had until of late, of first and foremost prioritizing preservation of capital, return of capital, as opposed to return on capital. So the fact that you guys are up after this violent and vicious market drawdown is a huge testament to that. So I thank you for walking your talk. All right, guys. Well, with that being said, so we've had a number of these conversations over the years where we've been warning about the potential for a big violent market downdraft like this. Mm-hmm. It seems like we've talked about the many different risks that are out there, from excessive debt to too much intervention by central bankers, too much liquidity, driving valuations way up above where the fundamentals lie. But it's true with all bubbles, nobody knows what the ultimate pin is going to be that pops it. Well, it looks like the coronavirus now might be being that pin. So we're seeing this downdraft. As we're talking today, the Russell is down 10%. The S&P is down over 7%. It is a complete bloodbath in the market today. It really seems that the action today, at least, is being driven by panic, right? Both people getting margin calls and they're being forced selling as folks are needing to meet those margin calls, but also just sort of standard investor psychology. People are panicking, they're running for the exits. What do you see, going forward from here? Do you see this continuing the next couple of days? Do you see perhaps the Fed and the other central banks, in the way they have in the past, stepping in to try to do some heroic rescue efforts here to get prices back up? And even if they do, looking forward perhaps for sort of the next 6 months, next rest of the year, what do you see happening? What do you see as more likely? Are we going to return back up to where, the highs in which we've been at? Or do you think that something fundamental now is broken in the market structure and that we may be drifting down lower from here? What do you think?
Yeah, so Adam, that's a great question. As you alluded to, the defensiveness that we have benefited from in our portfolios in this recent spate of volatility was defensiveness we've held for some time. The market has been tremendously overvalued for some time. Disjointed from all historical semblance of norms. As of the market high, a couple of weeks ago in mid-February, we were priced probably to decline 50 to 65%, pretty much run of the mill. That's not an extreme scenario relative to historical norms. So, it's really important to kind of look at the broader context here, not just the short term, but in the broader context, even though we've had a very sudden and sharp sell-off, by no means has this cleared the market of its excesses that have been built up over, frankly, the better part of the last at least half a decade, if not longer. Near term, I think volatility is going to reign supreme. I have no doubt there is going to be efforts, be they fiscal or monetary policy efforts, even just psychological assuasion on the part of policymakers trying to calm folks down. But I think what has changed markedly here is a complete shift in psychology. The fundamentals were kind of being thrown out, as meaningless by virtually everybody. And suddenly the psychology has kind of come back to rule in an opposite way than it's been ruling the last couple of years. So, I wouldn't be surprised. When we last talked to you, not even 2 weeks ago, we were expecting a very sharp short-term bounce, and we actually got slightly more bullish as a result of that. And within about 3 or 4 days, we booked profits on that short-term bullish trade because, markets had bounced sharply and have subsequently resumed their decline. So we expect more short-term tradable rallies in an overall kind of broader downtrend market that we think has got much further to go. One headline that we can talk about the stock market, and that's what most folks will be thinking about when they check their statements. But utterly jaw-dropping has been the drop in bond yields. The U.S. Treasury 10-year Treasury bond hit as low as 32 basis points, which is 0.32%.
Wow.
The prior low in the most aggressive form of quantitative easing was 1.5% or so in the 10-year. So we're right now we're about 0.5%. Even though we reached as low as 0.32% this morning, we're a full percentage point lower than where we were in the full-on heat of quantitative easing. This is tremendously concerning for markets. This is speaking to big money running for safety, or kind of purported safety, anyways.
Great. It's I think oil was down 30% today alone as well. I mean, we're just seeing just massive devastation going on in the markets right now. So, all right, John, thanks. I think that was a great answer. It sounds like you guys do see that the damage that's being done right now is not short term. When we talked again, 10 days ago or so, Mike, I think it was you who had said back then that you had thought that the market could fall as much as 60%. Are you guys still sticking to that prediction from the previous highs? And I know that you weren't necessarily calling for that, but you were saying that it could correct up to 60%. Are you still seeing that there's that much downside still left?
Absolutely. I mean, some of the downside has already happened, but we've been saying for many years now that we believe this market is historically overpriced, and a pullback of 50% from those highs, from the recent highs, would be totally run of the mill. Wouldn't even bring us back to middle of the road valuations. We think the 50% decline from the highs is quite likely, and we think we could see as much as 60, 70, or even more percent. As John said, there's probably going to be heroic actions by our policymakers to try to support the market. There will be jaw-dropping rallies that come out of nowhere. We did do a bullish trade about 10 days ago, like John talked about. We're looking at putting another one on soon, either today or tomorrow or the next day. Who knows? We're looking for a little bit more of a drop in the markets, but we don't think we're seeing capitulation, if you will, or panic. I mean, maybe it's panic, but it's very, very early. We're only, not even 2 weeks out, a couple weeks out, I guess, from all-time highs. And we think we've shifted into a bear market that's probably going to be with us for quite some time. So there's not going to be, in our view, a huge rush to do much of anything. The tactical trades that we're looking to do are just that, tactical, to try to make small little gains and then be out of them quickly on a bounce.
Okay.
A key point on, as we start to deploy, as we get further weakness, we have tools in our arsenal that kind of take the sting out of being wrong on timing. No one can be perfect in timing, and nor does one need to be. But one of the I guess unexpected gifts of heightened volatility is that volatility spikes up, and the premiums that options command start to become very rich. So, for example, one kind of textbook trade we could consider is buying some degree of stock exposure, could be broadly in the S&P 500 or something like that, and selling call options against that, a so-called cover call. And depending on where you set the strike price of that call option, you can become relatively more defensive or not. With these spikes in volatility, the premiums that we're able to bring into client accounts for these incremental trades are very, very rich and have the effect of insulating a large degree of downside, yet further downside if we get the timing, not exactly right. So we have tools that can navigate these waters really, really appropriately, we feel.
Great. And building on the tactical steps you guys have been talking about, let's talk strategy for a moment. So assuming things play out as you guys are forecasting, and at some point later this year, we're at even lower valuations where value begins to come back into play, right? Value's been a very scarce animal over the past couple of years as valuations have been so overinflated. But if prices get down to the point where quality assets begin to be priced at, or maybe even for a period of time below where fundamentals indicate, just walk us quickly through the process of how you guys will be looking for how good values might arise, and how you might pursue beginning to deploy the portfolio, because I know a lot of your portfolio to date has been in liquid assets, basically predicting that at some point lower prices were going to be ahead, and you wanted to have dry capital preserved. So as you go to start deploying that dry capital, just quickly walk us through the process that you'll be using.
Well, Adam, we're still close to 70% in cash and treasury bills after we were out of that bullish trade that we just mentioned a few days ago. So we're back to our over 2/3 allocation to cash and treasury bills. We'll be doing more of what we just talked about all the way down, assuming that the market continues like we think it will over time. In what could later be described as a bear market, we'll be adding exposure at correspondingly lower levels of the market. Right now we're taking a look at somewhere in the 2,700 area as being attractive, perhaps for another. That's on the S&P 500 for another bullish trade. However, we just stated that we think the market could fall 50%, and even if it does that, it could go to 1,700 or below on the S&P. So we have to have a game plan for how to increase bullish exposure as the bear market unfolds. And so we will be deploying different tranches of capital, different tranches of cash into the market at each subsequent decline in the market, and then adjusting on if we get very large rallies, we'll adjust and take profits. We may also adjust the option strike prices that we're using. But after all that's said and done, and let's say we have a historic bear market that wipes out 50, 60, or 70%, at some point the market will reach a level of valuation that makes sense. At the same time, the market will hit a swing low, test the low, and then hold that low. And then you'll start to see the market change character. You'll see certain sectors starting to break out before other sectors, and that's called relative strength. And so we'll start measuring relative strength, and we'll start noticing that the internals of the market are getting better, and that relative strength of certain sectors is getting better, and we'll start taking positions directly in those sectors at that time. Right now, all we're doing is taking broad exposure to the stock market, the S&P, the NASDAQ, or the Dow on these declines, because what we're really doing is we're taking advantage of volatility by selling options into this market. But who knows how long it'll take till we get to that clearing point where internals improve and the market puts in some kind of bottom. It's probably a year or so or more away if we're in a real bear market here.
And what's your guys' advice for people who are watching right now, watching the markets right now? And I've got two sort of different groups in mind. One is people who haven't taken any action to date. They've just sort of been long the market like most Americans, and maybe have a broker that's told them, don't worry, stocks are going to take care of you, stocks for the long haul. But they're now watching their portfolio kind of melt down here in real time. What would be your advice to those people? And then after you answer that question, people who have been listening to your advice and been getting defensive, maybe just sitting on a lot of cash, what would you be telling them right now too?
Yeah, I'd say a couple things. First off, we already talked about how even with the sudden sell-off we've seen in stocks of late, this is likely not over. Even if we get a furious bounce higher, that in our minds is an extra special invitation for folks to reconsider their allocations. At the end of the day, most folks are still more exposed than they either thought they were or want to be. And in that context, it's not too late, not even close to being too late. We've barely given back, we certainly haven't even given back all of last year's gains, which were in many ways ill-gotten. We had roughly flat earnings growth in the S&P last year, and yet the market was up 30%. We haven't, it's definitely not too late. But even folks that think they're conservative, they might be heavily in bonds. Given the move in bonds, I mean, it may be a very, very opportune time to sell down bond exposure because, we have just, seen yields crater, which, essentially moves the price of bonds higher. So we're not just talking about stocks here. We're talking about broad-based portfolio reassessment. And, we'd be happy to do that. It can take us as short as a 30-minute phone call with folks. If they want to share either verbally or certainly copies of statements, we can quickly help them assess, where their risk is, certainly relative to their own life situation. Many folks have worked hard to save, comfortable amounts of retirement funds, and their biggest risk is not, mistiming the perfect top. Their biggest risk here is unwittingly suffering a decline because they're trapped in a psychological battle that, forces them to have to go to work on another 10 years when they might be, otherwise ready to retire. So it's definitely not too late. We encourage folks to take a good objective look, and folks like us can help be that objective factor that we're not as emotionally connected to one's personal financial situation. We can kind of be objective and look at it in the broader scope of things.
Great. All right. So we've been having a number of these video conversations with you guys over the years, and we've worked at this relationship where anybody who is a Peak Prosperity reader can reach out to you guys, can schedule a consultation for free with you guys with no commitment expected, no strings attached. We want to make sure that people are getting good advice so that they can take informed action in their lives, and certainly taking good informed action around your financial portfolio is a very important step. And we send enough people over to you that you guys have been gracious enough to say, yep, we'll have those initial conversations for free, no commitments required. Mm-hmm. So if somebody's watching this and they decide that they want to have one of those consultations, and it's funny, we used to call them, you could get a free crash audit, but now that the market's actually sort of in mid-crash here, I think we'll just call it kind of a market meltdown or market correction audit, if you will. But for folks that want to have that conversation with you guys and bounce questions off you or get your feedback on how they're currently positioned and ways in which they might be able to reallocate their portfolios, we'll put a URL here with instructions on how folks can contact you. It's a very short form, folks. It takes about 30 seconds to fill out. And then you'll hear back from the guys at New Harbor to try to schedule that live conversation. If folks do that, very quickly, what should they expect?
Well, as soon as we get the information from that outreach form, they're going to get a call or an email or both, and usually right away, certainly within 24 hours. And we're going to set up calls, and either we'll catch them on the phone and we'll chat for a little while right there, or we'll set up a scheduled call and we'll evaluate where they're at. There's absolutely no obligation, as you said, Adam. We're happy to do it. We want to help. We want to help people. We know there's a lot of anxiety out there right now, and there's no right answer on exact timing, the perfect day to sell or to lighten up exposure. We talk to people all the time that are over allocated to equities, to stocks, because of this historic bull market that we've been in. But even at the present price of 2,750 or 2,800 roughly, the market is still not even down 20%, and still has only taken back, as John said, part of 2019 gains. So we'll help them not be paralyzed. If they're very heavily allocated, certainly over 80%, we're almost certainly going to ask them or suggest that they lighten up right away, a piece of it, sell something. We don't want to have anyone get hurt and panic out of everything right before a bounce, but at the same time, the gains in a portfolio like that are still very healthy, even at this level. And so we're going to want to help them start to move out of that exposure, probably in a piecewise fashion, if they want to be more cautious, or can even be faster than that. But certainly we're going to hold their hand and help them get more conservative. That very well may be even before, or even if they don't become clients here of ours. Oftentimes we're talking to people and, looking at their statements and telling them, how they can go ahead and get themselves into a more conservative posture right away. If they're self-directed, they can do that themselves. If they have another advisor, they can reach out to their advisor and have that done the same day that we talk. So we're a pretty small group. They'll talk to either myself or John or Justin. We're the ones on the phone with people like that on a day-to-day basis, and we really look forward to doing it. We want to help.
Great. All right. Well, with that, guys, we'll give people the opportunity to reach out to you. Again, very much value the service that you guys are providing. As we tell people, look, the key thing is these are scary time in the markets. This is when investor emotion oftentimes takes over, the fear, the panic, and can oftentimes lead to a lot of bad decisions. So it's the best time to talk to a professional who can try to take the emotion out of the decision-making process. Again, we think very highly from the guys at New Harbor. Really, our opinion is we just want you to work with a good professional. But if you don't already have one, particularly one that thinks the way that Chris and I and the folks at Gold Silver and a lot of the other experts that we have on Peak Prosperity, you want to talk to a firm like New Harbor, because they do get it. And guys, thanks so much for the great commentary that you've given today. But I think just the fact that you guys are up in a market that's been down 19% in just a matter of weeks is more testament than I think to anything that I can say about how your model performs for the type of market that we're in. So with that, guys, thanks so much for joining us. I'm sure we're going to have you on again quite soon. It looks like the market's going to continue to keep things interesting. So look forward to talking to you guys again in the next couple of days.
Thank you, Adam. We do as well. Thanks.
Thank you so much, Adam. Enjoyed it.